As the United States edges closer to another presidential election, the political landscape is more unpredictable than ever. With recent developments reshaping the race, the economic and fiscal policies that will emerge in the next administration are on everyone's mind. Investors, in particular, are keenly observing these shifts, understanding that the results could have profound implications for markets, tax legislation, and regulatory frameworks. The stakes are high, and the potential for significant policy changes has never been greater. With the rise of a new presidential candidate and potential shifts in congressional power, how might the upcoming election redefine the economic environment? What will these changes mean for investors and the broader economy? Election update: what a new presidential candidate could mean for investors. As the U.S. presidential election looms, the political landscape is becoming increasingly complex, with new dynamics emerging that could significantly influence economic policy and, subsequently, investor strategies. The focus has shifted to how these changes may impact taxes, the national debt, and regulatory frameworks. Each of these elements has the potential to shape the economic environment in profound ways, shifting political landscapes and their implications. Earlier this year, discussions around the election centered on how tax laws, regulatory changes, and geopolitical risks might evolve depending on the election outcomes. However, recent developments, particularly President Biden's unexpected withdrawal and Vice President Kamala Harris stepping up as the leading candidate, have brought new uncertainties. This shift has thrown a spotlight on how policy changes might unfold, leaving investors to contemplate the potential impacts on their portfolios. With Congress having only a few legislative days scheduled in September, a significant agenda item is ensuring the federal government is funded by October 1 due to the stalled appropriations process. A continuing resolution seems likely, at least until after the November election. Beyond the immediate concern of government funding, the groundwork is being laid for a potentially impactful lame duck session, where various policy issues of critical importance to investors could come to the forefront. The future of tax policy. One of the most immediate concerns for investors is tax policy. The provisions of the Tax Cuts and Jobs Act, TCJA, are set to expire at the end of 2025, creating a cloud of uncertainty over the future tax landscape. The House GOP has already begun forming tax teams in preparation for potential discussions in 2025. Maintaining the TCJA framework remains a priority for former President Trump and other Republicans, while Democrats, under Harris' proposed economic plan, aim to enhance benefits for lower-income families and potentially roll back broader investment incentives. Vice President Harris has laid out an economic vision that aligns with President Biden's tax priorities, but also introduces some key differences. She has advocated for raising the corporate tax rate from 21% to 28%, marking a departure from President Biden's stance. Harris has also supported a financial transaction tax and a bank tax in the past, indicating a potentially more aggressive tax stance towards corporations. For investors, these proposed changes could significantly alter corporate earnings and investment incentives, which would reverberate through the stock market and the broader economy. The uncertain path of tax reform. Efforts to pass significant tax legislation, such as the $79 billion Tax Relief for American Families and Workers Act, have thus far been unsuccessful. This bill, which proposed a temporary expansion of the child tax credit and other business tax extenders, could potentially be revisited in a lame duck session. However, its fate largely hinges on the outcome of the November election and which party controls the most seats in Congress. Should lawmakers fail to extend the TCJA provisions, individual taxpayers and businesses could see significant tax increases beginning in 2026, posing a challenge for long-term financial planning. Rising debt and fiscal concerns. Another pressing issue is the nation's growing debt. The U.S. debt-to-GDP ratio is projected to reach an unprecedented high as we move into the next decade, sparking concerns about the long-term fiscal outlook. This situation is expected to place intense pressure on tax and spending debates in 2025 as the country faces another potential debt ceiling showdown. The temporary suspension of the debt ceiling is set to expire on January 2, 2025, with the critical X date, the point at which the government can no longer meet its financial obligations, likely falling in the second quarter of the year. High deficits and repeated funding crises may lead to the creation of a special committee dedicated to addressing the U.S.'s long-term fiscal challenges. While such discussions could pave the way for meaningful action, the path forward is fraught with political hurdles, and the likelihood of substantial reforms remains uncertain. New tariff policies on the horizon. Trade policy is another area where upcoming elections could result in significant changes. Former President Trump has indicated a desire to implement new tariffs as part of his campaign, which could exacerbate the trade tensions that began during his previous administration. These tariffs, if enacted, could have far-reaching effects on U.S. consumers and businesses, potentially raising prices and reducing market efficiency. On the other hand, a potential Harris administration's approach to tariffs remains unclear. While the Biden administration largely retained Trump-era trade policies, whether Harris would choose to maintain the status quo or pursue a different strategy remains to be seen. Investors will need to closely monitor these developments, as changes in trade policy could significantly impact global supply chains and international market dynamics. Regulatory environment, a time of uncertainty. Regulatory policy is yet another area that could see shifts depending on the election results. Vice President Harris, now the Democratic candidate, may bring some continuity in regulatory policies, but could also introduce new changes reflecting her distinct policy views. Should the Democrats retain the presidency but lose control of the Senate, confirming new cabinet nominees and passing new regulations could become more challenging, leading to potential stagnation in policy implementation. Conversely, a Republican victory could result in a swift pivot toward deregulation, especially if Trump returns to office. Historically, Republican administrations have favored reducing the regulatory burden on businesses, which could foster a more favorable environment for certain sectors. However, the recent Supreme Court decision in Loper v. Bright has further complicated the regulatory landscape by overturning the Chevron doctrine, which previously allowed federal agencies greater leeway in interpreting laws. This change could limit the ability of a new administration to implement broad regulatory changes, adding yet another layer of uncertainty for investors. The bigger picture, political dynamics and investor concern. Ultimately, the upcoming election and the degree of political power concentration will significantly influence economic policies and the overall market environment. Investors must stay vigilant, focusing on the potential shifts in tax policy, regulatory frameworks, and fiscal strategies rather than getting caught up in headline-driven political dramas. These policy changes could profoundly impact the economy, market stability, and investor portfolios in the years ahead. As we look toward an uncertain future, the question remains, how will the next administration shape the economic landscape, and what will this mean for your investments? What are your thoughts on the potential changes in policy, and how do you think they will affect the economy and your financial strategy? Share your opinion in the comments below.